Ladies and gentlemen, welcome to week 2, Strategy Week and Advanced Product Week. This particular week we will cover about 45% of NASDAQ. And I'm going to start with about 1/3 of the exam today. Today, direct participation programs known as tax shelters. You'll find out why. Tonight, and I say tonight, stay a while, will you? Because we're going to be here for a while. We'll be going into the areas in the regulations associated with margin strategies. So we're into advanced products and advanced strategies, and every single area that I cover is NASDAQ. Are you with me?
Yes.
Have you done your due diligence to prepare yourself today?
Yes.
I want to talk to you a little bit in English about the basic language of English, about this particular product, this particular investment strategy, this particular tax shelter, known as direct participation programs. But before I do, I want to trade with you right away. I'd like you to come down with me to a place that I have been working, if you'll indulge me for a moment, for the last 20 years of my life. Welcome to Waco, Texas. And I want you to all breathe in today, if you could just, one moment. I want you to tell me what you think you smell. Well, let me tell you what I think I smell. I smell oil in them there hills. And guess what I want to do? I want to drill for that natural resource. Now, I'm going to need some capital. So if there are about 25 of you in the room, I'd like you to assume that, using a number as an example, that I require $1 million from each and every one of you as investors to invest in this program to drill for this natural resource. You are known as the limited partner, the investor, providing the program's capital. I am known as the general partner, the active manager of this program. I'm going to assemble your capital, which totals in aggregate about $25 million. I'm going to take that money right down here in Waco, Texas, and I'm going to drill for that natural resource. Now, if I am right, and I hit crude, are you with me so far?
Yes.
I will, as your active manager of this program, sell that crude out there in the secondary market immediately. And through the sale of that natural resource, I will directly pass flow through right back to each and every one of you investors' income. Are you with me so far?
Yes.
This income that I am qualifying that you will receive from a profitable program is known as passive income. Write it down. Which is the income that's being received by the limited partner from the investment. Passive income is income that is not active. You are not performing any active function in the active management of this program. That's my role as the active manager and the general partner. You have one responsibility as the investor in this partnership between you and I. Sit back, provide the program's capital that's required of you, in my example, $1 million from each and every one of you, and receive income, passive income, from this passive activity from your investment of a profitable partnership. Are you with me so far?
Yes.
So if the program is profitable, I will distribute income to each and every one of you in the form of passive income. Now, what if I'm wrong? What if I hit a dry hole? What if there's no crude? Are you with me so far?
Yes.
Well then, this program will incur losses. Are you with me so far?
Yes.
I, again, as your fiduciary and active manager of this partnership, will take those losses, are you with me so far,
Yes.
and distribute those losses to each and every one of you investors in the form of passive losses. Everything that the investor receives, whether it's profits or losses, is in the form of passive income or passive losses, because you are a passive investor. Are you with me so far?
Yes.
Now, let's talk about those passive losses just a little bit more. If I distribute passive losses to each and every one of you, just like I may have in the form of passive income, those losses that were distributed to you from a non-profitable partnership, from a non-profitable program, will accumulate on your tax returns. Are you with me so far?
Yes.
And will be carried forward year after year after year, and will be used as a deduction and as a write-off against any and all future passive income whenever the program becomes profitable. Let's take a look at this transaction to show you exactly what I mean. At the beginning of the year of 2009, a limited partner had invested in a partnership. Are you with me so far?
Yes.
Whether it's oil and gas and or real estate is irrelevant at this point. By the end of that tax year, that partnership distributed nothing but losses to you. There was no profits. Are you with me so far?
Yes.
$500,000 in passive losses were distributed to you by the end of the year. Are you with me so far?
Yes.
I just said that those passive losses that you received in any tax year are to be carried forward and are to be used in a future tax year whenever the company becomes profitable, whenever the partnership becomes profitable. Are you with me so far?
Yes.
So let's take the $500,000 in the program's passive losses that you received from the end of the tax year of 2009. Let's carry them forward to the following tax year of 2010. Now let's take a look at what happens in 2010. In 2010, these $500,000 in passive losses were carried forward to this year. Are you with me so far?
Yes.
The program started to distribute profits to you for the very first time. How much? $250,000 of passive income. Passive income is taxed Series 7 just like earned income is taxed. Are you with me so far?
Yes.
But what did we say we can do with these passive losses that have been carried forward from the previous tax year? Well, look closely. They're to be used as a write-off and as a deduction on a dollar-for-dollar basis against any and all passive income. So that means financially, let's take the $500,000 in passive losses in the year of 2010 that were carried forward from the previous tax year of 2009 and use them on a dollar-for-dollar basis as a deduction and as a write-off against the $250,000 of passive income. Are you with me so far?
Yes.
Remember, the passive income is normally taxed as earned income is taxed to the limited partner at OI. Are you with me?
Yes.
So if I take $500,000 of passive losses and use it as a write-off on a dollar-for-dollar basis against the $250,000 of passive income, my excess would be $250,000 of excess passive losses. And because my existing passive losses, which were $500,000, exceed my existing passive income that was distributed to you in the year of 2010 by $250,000. What are you going to do with those excess passive losses at the end of the tax year of 2010? Carry them forward to 2011. Are you with me so far?
Yes.
Take a look at what happened in 2010. You received $250,000 of passive income with no tax liability on the $250,000 of income. Are you with me so far?
Yes.
Because your existing losses exceed your existing income by $250,000, and the next year, in 2011, these excess passive losses of $250,000 are carried forward and used as a future write-off against future passive income. Are you with me so far?
Yes.
Now, in taxation and tax law on Friday, we said, with respect to earned income, watch my language, you may not write off any more than $3,000 of capital losses on securities transactions against earned income from your career and your job in any one tax year. Are you with me so far?
Yes.
We said excess capital losses and then carry forward to the following tax year. So there is a limit on how much money you can use as a write-off of capital losses against earned income on a dollar-for-dollar basis in any one tax year. Am I right?
Yes.
So the limitation is on capital losses against earned income. We're not talking about capital losses right now, and we're not talking about earned income. We're talking about passive losses as a write-off against passive income. The point is that there is no limit on how much money a limited partner can use as a write-off and as a deduction of passive losses against passive income in any one tax year from an investment of a program. Are you with me so far?
Yes.
Why, I can distribute to you $27 million of passive losses. You can use it as a write-off against $32 million of passive income. Are you with me so far?
Yes.
So 100% of any and all passive losses, 100% of any and all passive losses that are distributed to you from a non-profitable partnership are used as a write-off against any and all passive income. When you reduce passive income with the passive losses by the program's deductibility, are you with me so far?
Yes.
With the program's write-offs, by taking those passive losses on a dollar-for-dollar basis as a write-off against passive income, what are you doing to passive income? You're reducing your tax liability on passive income. Here, in the year of 2010, you not only reduced your passive income, you eliminated any tax liability on the $250,000 of passive income, which is normally taxed at OI, because your passive losses that were carried forward from the previous tax year are used as a write-off against that passive income. When you take $500,000 of passive losses and use that as a deduction against $250,000 of passive income, you have excess passive losses that will be used as a future write-off in 2011. Show me another investment where you can receive income without a tax liability incurred. Are you with me so far?
Yes.
You're dealing with accredited clients. Are you with me so far?
Yes.
And you're dealing with an investment that is known as a security, which is called a tax shelter. You're sheltering income. Where is the income that you're sheltering? The $250,000 of passive income is being sheltered because the program's losses exceed the program's income by $250,000. Are you with me so far? That's where the tax shelter lies in limited partnerships, in the ability to take 100% of any and all passive losses as a write-off against any and all passive income. If the excess is passive losses, Those excess passive losses are carried forward to the following tax year to be used as the future write-off against future passive income. This concept of taking passive losses as a deduction against passive income to reduce your tax liability on passive income is known as 7. Flow-through tax treatment. Never forget this concept. It is the most foundational concept of all limited partnerships. And again, what does that mean? Well, I'll show you again if you'll look at me one more time. It is the distribution and the flowing back to each and every one of you limited partners of any and all passive losses from a non-profitable program. And those passive losses in any tax year will accumulate on your tax returns and will be carried forward to the following tax year to be used as a write-off and as a deduction without dollar limitation against any and all passive income. When you reduce passive income with the program's passive losses, you achieve the tax shelter afforded by the investment because you're reducing your tax liability on passive income. Are you with me so far? Yes. With passive losses. This concept of taking passive losses on a dollar-for-dollar basis without limitation as a write-off and as a deduction against passive income is known as flow-through tax treatment. So losses, passive losses, are favorable in a limited partnership program because they are carried forward and they are used as a write-off whenever the program starts to pay out passive income. Are you with me so far? Yes. The results of this investment from a limited partner's point of view flow down to the investor. This is critical language. What does that mean? It means that they are called, these investments, direct participation programs because the general partner ensures that each and every one of you limited partners will directly participate in the financial activity that goes on throughout the program life. And that is taken in the form of receiving any and all passive income or receiving any and all passive losses. Are you with me so far? Yes. You are participating in the income or in the losses of a profitable or a non-profitable program. Are you with me so far? Yes. Flow-through tax treatment. The distribution of any and all passive losses to you, flowing down to you from the program's non-profitability, accumulating on your tax returns, and used as a write-off against any and all passive income on a dollar-for-dollar basis without limitation to reduce your tax liability on passive income to achieve the tax shelter afforded by this investment. Sheltering passive income with the program's losses. 7. That's what I want you to know. Are you with me? Yes. Critical in language. And so, we look at limited partnerships and we look at the only 2 classes of partners that we have. Are you with me so far? Yes. There are limited partners and they are program passive investors. You may not hire, you may not fire, you may not negotiate any active contracts in this investment. You have one responsibility. Sit back, stay passive, and provide the program's cost basis. Receive any and all passive income. Receive any and all passive losses. Use those passive losses as a deduction, as a write-off against passive income. Are you with me so far? Yes. In the real world, not on the 7, when you file your tax returns, are you with me so far? Yes. There is a special tax return that has to be filed known as a K-1 form that itemizes passive income and passive losses segregated from the normal tax returns of earned income and capital losses to the IRS. The K-1 form is a form that limited partners file that itemizes any and all passive income and any and all passive losses. So if you're on the phone with an accredited investor and he says, I'd like some investment advice regarding the filing of my K-1 form, you already know he's a limited partner. Are you with me so far? I just thought to let you know that in the real world because you're dealing with sophisticated and accredited clients. And in a moment later on today when we get into the qualification of suitability of limited partners, you'll see just how accredited and sophisticated they are. Are you with me so far? Yes. Okay, so we talk about the passive investor. You have one responsibility, provide the program's cost basis, and participate and receive as limited partners in the flow-through tax treatment of the partnership. Are you with me so far? Yes. Then, of course, we have the general partner who's the program's active manager. Active manager means that he's working for an active managerial fee. I represent you as the fiduciary to your investment. Are you with me so far? Yes. My acts bind you. Are you with me so far? Yes. You will give me power of attorney in the management of this partnership. My primary responsibility is to distribute out any and all passive income and any and all passive losses to you and manage this partnership. Are you with me so far? Yes. Which means to receive your capital and use that money for the intended use of the program, whether it's to engage in real estate investments on the real estate side in the form of a partnership between you and I, or to engage in oil and gas program investments. Are you with me so far? Yes. I also have the responsibility to maintain the partnership's books and records. Are you with me so far? Yes. And I, as your general partner and fiduciary in the management of the partnership, receive an active managerial fee. Are you with me so far? Yes. I have another name besides known as the general partner in this partnership. I am known as Series 7, the program sponsor. It is my program. Are you with me so far? Yes. I am looking to sponsor its capital raise. I am looking to manage this partnership, looking for investor capital, and looking to distribute out any and all passive income and passive losses to you to work for an active managerial fee. And so clearly, you can see the difference between you and I. Active manager, GP, program sponsor, passive investor, and limited partner. And we'll find out where you get that name limited in a moment. Are you with me so far? Yes. Now, so there are only two classes of partners, am I right? Am I right?
Yes.
Now, there are certain advantages and certain disadvantages of structuring and designing this investment as a partnership between you and I, as opposed to what other entity? Well, they don't really tell you that in the body of the work. And the other entity that we're referring to is known as, listen carefully, a corporation. Here's my point. The advantages and the disadvantages of structuring and designing this investment between limited partner investors and program general partner and managers as a partnership entity are only based upon and compared to if we would have been a corporation. Are you with me so far? Let's take a look at exactly what I mean. Only in limited partnerships, advantage number one, as opposed to being a shareholder in a corporation that's using investor capital for oil and gas investments or real estate investments, do investors here known as limited partners participate and receive flow-through tax treatment. Are you with me so far?
Yes.
Only here, as a limited partner, as opposed to a shareholder in a corporation, are you receiving passive losses used as a write-off against passive income. Are you with me so far?
Yes.
Let's get down to Waco, Texas. I received your capital. I have $1 million from each and every one of you. Are you with me so far?
Yes.
And I'm using that capital for the hiring of the labor, the lease expenditures for the industrial equipment, for the drills, which are, by the way, the size of the commercial building you're sitting in right now. They're quite elaborate. I'm using that capital for the topography report, which is the survey of the land, for a chemical analysis and a core analysis. I'm getting ready to drill for that crude. Are you with me so far?
Yes.
I'm using that capital as working capital, getting ready for the drilling of that natural resource. And I want to tell you that as I got down there, I see that the program might experience further capital requirements. Are you with me so far? I might look to secure a loan on behalf of the partnership over and above your cost basis. Are you with me so far?
Yes.
But more importantly, we'll get into the financial arrangements of what the general partner's resources can be available to him in addition to your cost basis. But I now want to get into the entity itself. The partnership goes down to Waco, Texas, and it hits crude. And it's successful now. It has secured a successful level of natural resource. The general partner's first reaction, as I told you, is to take that natural resource and sell that natural resource out there in the secondary market. Are you with me so far?
Yes.
And that will transfer income. So now this program is now profitable. Are you with me so far?
Yes.
And the next step for the general partner is to distribute out those profits to each and every one of you in the form of passive income. Are you with me so far?
Yes.
Before we get to that distribution, I want to talk about the partnership itself, the entity itself known as the partnership. The partnership has generated profits. Are you with me so far?
Yes.
Give me the tax bracket of the partnership. What is a partnership tax bracket? A partnership tax bracket. Before you answer that question, let's switch the entity for a moment, because obviously you're not sure. You're a shareholder in a corporation. Watch me now. I just switched the entity on you. I'm no longer talking about partnerships. I'm talking about the entity known as a corporation. Are you with me so far?
Yes.
We have a board of directors. We have a corporation. You are shareholders. You've invested $1 million as a shareholder in a corporation. This corporation takes that money, goes down to Waco, Texas, and starting to use that capital to the drilling of crude. Are you with me so far?
Yes.
The corporation hits oil. The corporation takes that oil and sells that oil out there in the secondary market. And the corporation turns a profit. Are you with me so far?
Yes.
Give me the corporate tax bracket that the corporation would have to pay on the corporate profits. 35%. Are you with me so far? The corporation's tax bracket, it's a taxable entity, am I right?
Yes.
Is 35%. So what would happen is, from a tax liability point of view, is first the corporation would pay a 35% corporate tax on the corporate profit, and then the corporation would start to distribute the profits to the shareholders who've invested money in the corporation. Are you with me so far?
Yes.
And then you would be taxed individually on your portion of your shareholder profits. Am I right?
Yes.
That would be the structure of the tax liability of corporate profits if we were a corporation. Now I want you to switch your mind to being being a limited partner who have invested $1 million in a partnership. The partnership goes down to Waco, Texas with your $1 million in capital, hits oil. Are you with me so far? Yes. The partnership now sells the oil out there in the secondary market, and the GP turns a profit for the partnership. Now the partnership is profitable. Are you with me so far? Yes. Give me the tax bracket of the partnership's profits.
Not a taxable.
Correct. Partnerships, per se, as an entity, is a non-taxable entity. Corporations are taxable entities at the corporation 35% tax bracket rate. Am I right? Yes. There is no partnership tax bracket rate. Are you with me? Yes. Because the entity is a non-taxable entity. Well, wait, what do I mean? I mean that if the entity that you're a limited partner of is a non-taxable entity, are you with me so far? Yes. Then what does that mean regarding your tax liability of your portion of the profits in the form of passive income that was just distributed to you from the partnership's profits? Look at me. It means that limited partners are only going to be taxed once. The entity itself doesn't have to pay a tax liability on the profits because the entity, known as the partnership, is a non-taxable entity. Am I right? Yes. Which means that because you're an investor and a limited partner in a non-taxable entity, you have an opportunity as limited partners, as opposed to shareholders in the corporation, to retain on a higher level of profit than you would as a shareholder in a corporation that would first have to pay a corporate tax, and then you're taxed secondarily on the portion of shareholder profits. Here, limited partners are only taxed once, in bracket. Are you with me so far? That's how any partner is taxed in any partnership, because the entity itself, known as the partnership, is a non-taxable entity. So what's the second advantage of wanting to structure this investment between you and I as a partnership as opposed to being a corporation? To becoming an investor, are you with me so far, in an entity Series 7 as a non-taxable entity. Series 7. Sure. That's a significant advantage. Now, we said that we would find out where limited partners get this names from, known as limited partners. Are you with me so far?
Yes.
The actual name of the partnership, are you with me so far?
Yes.
Look at me. It's called, if you will, the ABC New York Oil and Gas Exploratory, if you will, LLP, Limited Liability Partnership. Are you with me so far?
Yes.
LLP, not LLC, not Limited Liability Corporation, Limited Liability Partnership. The entity is known as the partnership. With me so far?
Yes.
This name, limited liability, comes from this concept known as the third advantage, and very important, to limited partners. In that, you've invested $1 million in Waco, Texas, required by the general partner in order to be accepted as a limited partner in this program, under the assumption, as we'll see in a moment, that you qualify for suitability. Are you with me so far?
Yes.
If you lose capital in this investment, there's always capital risk. Are you with me so far in any investment? The maximum that you can lose in this investment, listen to me very carefully right now, is the $1 million. You may not incur losses that exceed your original investment. Are you with me so far?
Yes.
We get into that language from Friday in taxation called your original basis. Watch my language. The original basis is the original dollar amount of money that you've invested in the security, or even so far,
yes,
in this tax shelter. The original capital that you've invested in this program is $1 million. Am I right?
Yes.
You can lose the $1 million. Look at me carefully. You can lose the $1 million. But your losses may not exceed that $1 million investment. You can't lose $1,000,001 cent. Are you with me so far?
Yes.
And so your capital risk in this investment is limited. Watch my language now. I'm going to talk like the 7 right now, to your original basis. Your original basis is the original dollar amount of money you've invested in the partnership. You with me so far?
Yes.
That's the original cost basis of $1 million in my example. So your liability, limited partners, is limited to your original investment. Your losses may not exceed your original basis. And that's going to be a considerable advantage in this investment, because that is an advantage in the marketplace in any security investment. Your losses are capped. Are you with me so far?
Yes.
Your losses may not exceed your original investment. Whenever there is an investment or a strategy that can place a ceiling on the maximum losses that you can incur and no more than, that's always going to be considered an advantage by the market's investment standards. Are you with me so far?
Yes.
You can lose $1 million, but your losses cannot exceed $1 million in investment. Are you with me so far?
Yes.
You can't lose $1,000,001 cent. So there's capital risk that's limited to your original basis. This concept concept that talks about the maximum losses that a limited partner can incur and no more than is known as limited liability. Series 7, your liability in this investment is limited. Series 7 to your original basis. Take a look more acutely now at these three advantages. They are the advantages of any limited partnership. With me so far?
Yes.
The most important advantage, of course, foundational to the entire structure of any limited partnership program, is flow-through tax treatment. The ability to have the write-offs that yield this tax shelter, the ability to take passive losses that have been distributed to you in any tax year, and on a dollar-for-dollar basis without any limitation, take those passive losses as a deduction against passive income to reduce your tax liability on passive income, which is to achieve the tax shelter afforded by the investment. Are you with me so far?
Yes.
Which is significant, and we will numerically come back to flow-through tax treatment many times today. Are you with me so far?
Yes.
To be an investor in an entity that's non-taxable. Are you with me so far?
Yes.
And to experience losses that do not exceed your original investment. Three significant and very powerful advantages as we continue to lay down the characteristics and the structure of all limited partnerships. Are you with me so far? Like any investment, there are disadvantages. Are you with me so far?
Yes.
Disadvantage number one. There's only one manager of this program, and that is the general partner, that is the program sponsor, who controls your capital. Yes, you've given me power of attorney, but remember, through that power of attorney, my acts bind you. With me so far?
Yes.
My investment decisions is what you are required to go with on this investment. And so therefore, as a result of the power of attorney you've given me, I represent you as a fiduciary. There is only one manager of this partnership. I control your investment. From an investor point of view, that's considered to be a disadvantage. Are you with me so far?
Yes.
Which you would gladly give up because of my expertise in the management of this partnership to be able to distribute out income to you ultimately down the road, if not initially. And these investments are long-term and illiquid in nature. Second disadvantage, just like the illiquidity when we get into fixed income on the bond side, whenever you're not access to your capital, it's never by the market standards going to be considered an advantage. Are you with me so far?
Yes.
The actual holding period is not on NASDAQ of when a limited partner actually receives his original cost basis out of this investment, let alone any potential income and gains. Are you with me so far? Yes. But it is anywhere between an average of a 2.5 to a 5-year period of time, depending upon the nature of which specific program you're investing in. But they are long-term and illiquid in nature. Two advantages, three advantages. We lay down the structure and the characteristics of partnerships. We talk about your role, my role, your class, my class, and now I want to go out and form a partnership. Are you with me so far?
Yes.
There are two requirements, Series 7, for partnership formation. 7, bullet 1. I need one LP and one GP. Listen to me very carefully today. One LP and one GP forms a partnership. Look at me. All I need is one investor and one manager, and I have the first requirement for partnership formation. But there's another requirement to form the partnership besides one LP and one GP. Before I get into that second requirement, look at me now. You got to think here this week. We have 25 limited partners in this room. Don't need 25 of you. Just need one limited partner. We could have more than one general partner, more than one active manager managing the same partnership on your behalf. Don't need 2 or 3 or 4 general partners. Just need one LP and one GP. Keep that in mind. Are you with me so far?
Yes.
And we're going to need a document. The second requirement to form any partnership is called the Certificate of Limited Partnership. Now, whenever we talk about documents that bind a particular investment or a strategy or an underwriting, are you with me so far?
Yes.
We have to know the purpose of these documents and all-inclusive provisions. Are you with me so far?
Yes.
The first purpose, Series 7, of the Certificate of Limited Partnership is, Series 7, to form the partnership. So when NASDAQ asks you for the 2 requirements for partnership formation, what are you going to say? You're going to say one LP and one GP and a Certificate of Limited Partnership. The second purpose of the Certificate of Limited Partnership is that this document will serve as the basic program outline of the partnership. It's got your name, my name, whether you're an LP, whether I'm a GP. It's got the name of the partnership. It's the basic agreement. Are you with me so far?
Yes.
Can't form the partnership without it. If this is a basic agreement, the ABC, Waco, Texas Exploratory Oil and Gas Limited Liability Partnership, are you with me so far?
Yes.
And itemizes limited partners and general partners. The basic agreement should also have, look carefully right now, the cost basis on how much money a limited partner is required to invest, and it's right there. There's the provision of the cost basis. Are you with me so far?
Yes.
In my example, the $1 million. Basic agreement necessary for partnership formation. And so now, I get down to Waco. Are you listening to me?
Yes.
And Waco, Texas hit oil. in the drilling of that natural resource. Thank you very much. I was right. I sell that crude out there in the secondary market. Are you with me so far?
Yes.
And in Waco, Texas, the partnership generates a profit. Are you with me so far?
Yes.
Income. We're profitable. This document, which I haven't left, talks about the sharing arrangement of the income of the profits of a profitable partnership between LPs and GPs. That provision means this. What percentage of the income and the profits of a profitable partnership will you receive as investors, and what percentage of that profits will the general partner participate and receive in? This document has this provision built into it that talks about the allocation of income between investors and managers. Are you with me so far?
Yes.
You studied 4 different types of sharing arrangements of income between limited partners and general partners of a profitable partnership last night. They were, just to refresh your memory, functional allocation, overriding royalty interest, disproportionate sharing arrangement, and revisionary working interest. Those 4 are different types of sharing arrangements of the income distribution between investors and managers of a profitable partnership, all set forth, please look up, in the certificate of the income, of the income, of the income. Agreed?
Yes.
I have a real problem with this provision. I need you to look up right now. I would like to know why this provision does not also talk about the sharing arrangement of the losses between limited partners and general partners. How come it's only of the income? Can anyone help me here today? How come this provision doesn't also talk about the allocation between investors and managers of the losses of the partnership? How come it's only of the income? Any ideas? I really need you to think this week. I really need you to brace yourself. Are you with me so far? Because we're dealing with a tremendous amount of regulation that's all-consuming. How come it's not of the losses as well? How come it's only of the income?
Claim the losses?
Claim the losses? What does that mean, claim?
Claim them at the end of when you lose. Do you claim them with taxes?
I'm trying to find out what the word claim means. I just need you to be more specific.
Write-off? Claim as a write-off?
Write-off, claim? I'm really not, it's not correct. But it's not a bad response, it's just not accurate. It's ambiguous, too.
The general partner doesn't share in the losses?
The general partner shares in losses that are active losses, just like he receives active income. But you're getting close, but that doesn't answer the question as to why that provision doesn't talk about the losses between you and I of a non-profitable partnership. You see, it's okay. I know you don't know. I'm going to go for it right now. I was hoping you were going to say these words to me. Could you say them again?
Okay.
No, I want you to say these words to me again. Flow through tax treatment. I don't ever want you to forget those words. When we established at the beginning of this partnership the concept of flow through tax treatment, the loss side was already established. In that, passive losses are distributed and borne by whom? Limited partners, because you're a passive investor. Active losses are paid for and borne by whom? The active manager of the partnership. Watch this. What happens if the partnership experiences and incurs any expenses? Are you with me so far?
Yes.
I didn't say the word losses, I said expenses. What happens if those expenses are deductible expenses? The minute I use that word deductible, there's only one class of partner here who has deductibility, and it's not me. Who is it? A limited partner. So what are you going to do with those program deductible expenditures? You're going to pay for them as incurred, limited partners, and you're also going to use those deductible expenditures along with any and all passive losses as a deduction against passive income. Are you with me so far? What happens if the partnership experienced non-deductible program expenditures? If they're non-deductible expenses, who do you think pays for those? The general partner, because I don't have deductibility. The minute you hear the word deductibility, you think limited partners, because only you have the capacity to use these passive losses and deductible expenditures as a write-off against passive income. And so when we establish the concept of passive losses flow through tax treatment, are you with me so far?
Yes.
The loss side is already established. Are you with me so far?
Yes.
And that only remains for the different types of sharing arrangements of the income between you and I set forth in the basic certificate. Are you with me so far?
Yes.
That's why we don't need that loss provision here, because flow through tax treatment is already established. The loss side is already established. Are you with me so far?
Yes.
Stay very focused, please. Now, you're going to find a little bit later on when we talk about corporations. I just switched the entity on you. Stay with me. That the IRS has established 4 characteristics that are built into the infrastructure of every corporation that is required in order for the corporation to be functioning as a corporation. And you're going to find that every corporation must have a centralized management team in order to be designed as a corporation. Every corporation allows its shareholders who've invested stock in that corporation, invested money in that corporation, to freely transfer by gift or sale their investment to another shareholder. It is a shareholder right and a corporate characteristic. Are you with me so far? The the ability of a shareholder to freely transfer by gift or sale their investment to another shareholder. It is a corporate characteristic. Every corporation requires the concept of limited liability, in that if you invested money as a shareholder in a corporation, you're limited to those investments. They can't not come after you with any specific personal financial guarantee. Your liability is limited to your investment as a shareholder in a corporation. And every corporation, are you with me so far?
Yes.
Most importantly, the fourth characteristic has the concept known as continuous life. That means that there is no characteristic, financial and or otherwise, that will kill a corporation's life. It has continuous life. Yes, that means it's true. Thank you. But the IRS has stepped in and said, listen, you want to be designed as a partnership, agreed? And we said yes, desperately. Now the question becomes, why are we working so hard to be structured as a partnership? What is really the big difference as to whether we're a partnership or whether we're a corporation? I mean, what's the whole game associated with this structure here? Why do we care so much about being structured as a partnership? Why are we doing everything in our power to avoid being structured as a corporation? Can anybody tell me? Tax shelters. Only in corporations. It's got nothing to do with flow-through tax treatment. You see, I knew you were going to give me the concept when I didn't want it, and you don't give it to me when I should. Are you with me so far? When you should give it to me. Flow-through tax treatment is the advantage that limited partners receive when we are structured as a partnership. Are you with me so far? Yes. That is not why we're desperately working so hard to be structured and designed as a partnership. Are you with me so far? We are working so hard to avoid being structured as a corporation and to be structured as a partnership because we want to be investors in an entity that's a non-taxable entity. Are you with me so far? Yes. That's why. Well, the IRS clearly understands that we want to be structured as a partnership so that we can be limited partners and investors in an entity that's a non-taxable entity. Are you with me so far? Yes. So the IRS says, listen, if you want to be a partnership, you cannot have more than 2 of those 4 corporate characteristics that are prevalent in the infrastructure of every corporation. If the partnership entity has 3 of those corporate characteristics, it's a corporation. Are you with me so far? Yes. Knowing now the structure of partnerships, are you with me so far? Yes. And those 4 corporate characteristics that are prevalent in every corporation, can we take a look at which 2 that we can eliminate of those provisions that is built into every corporation and which 2 we must maintain that is prevalent in every corporation so that the partnership possesses no more than 2 of those 4 corporate characteristics so that the partnership can be designed as a partnership and take the favorable advantages that are only afforded to partnerships, unlike corporations. Can we eliminate in a partnership and its structure centralized management? Yes or no? No. No. Who is the centralized manager here? You want to eliminate me? Who's going to manage the partnership? Are you with me so far? So we must maintain Series 7 Bullet 1, the centralized management of the partnership, because that's the general partner. Got to maintain that corporate characteristic. Can we maintain limited liability? Can we eliminate, I should say, limited liability? No. Limited liability is the third advantage of any partnership, which goes directly to benefit the limited partner, which says your liability is limited to your original basis. So we can't eliminate that concept. It's the third advantage of partnerships. Are you with me so far? Yes. So we must, Series 7 Bullet 2, maintain in the partnership structure limited liability. Am I right? Yes. Can we eliminate, look at me, a limited partner's ability to freely transfer by gift or sale part or all of your investment in Waco, Texas to another limited partner? The answer is yes. If I require that your transfer by gift or sale of part or all of your investment in your partnership be contingent upon the general partner approval, are you with me so far? It's no longer free for you to transfer by gift or sale your investment, part or in full, to another limited partner. Are you with me so far? Yes. Therefore, Series 7 Bullet 1, we have now eliminated in the structure of the partnership the ability of a limited partner to freely transfer by gift or sale part or all of your investment in Waco, Texas to another limited partner. It's no longer free for you to do so. It is 7, contingent upon general partner approval. And finally, in order to be structured and designed as the partnership, we must eliminate continuous life. Are you with me so far? Yes. so that this partnership possesses no more than those two of those four corporate characteristics, so that we can be structured as a partnership to receive the favorable advantages that only partnerships can afford to limited partners. And so, I would like to tell you what happened at 7:37 a.m. this morning on the property, the drill site of Waco, Texas, that contains your $1 million in cost basis that's being utilized for the drilling of that natural resource. Are you listening to me?
Yes.
There was an explosion this morning on the drill site, and Robert Hill passes away. Who's Robert Hill? First time I mentioned this guy to you. Robert Hill is another general partner. Along with there were two active general partners managing your partnership. Are you with me so far?
Yes.
We said we didn't need two general partners. We said we didn't need 25 limited partners either. We said to form the partnership, we only needed one LP and one GP. Am I right?
Yes.
But we could have more than one limited partner. We do. We have 25. We could have more than one general partner. Could have. Are you with me so far? Not required. And here we had in Waco, Texas, right down there on our partnership property, are you with me so far?
Yes.
Two active managers, myself and Robert Hill. A general partner dies in an explosion. Are you with me so far?
Yes.
General partner Robert Hill retires right in the middle of managing your partnership, looks at me and says, I no longer have the energy to continue to effectively, actively manage this partnership with you, and so I retire right in the middle of actively managing this partnership. Are you with me so far?
Yes.
A general partner, Robert Hill, decides to go off his medication and goes insane. Are you with me so far?
Yes.
A general partner goes insane. I, the remaining and surviving general partner of Waco, Texas, your partnership, contact each and every one of you up and ask you to fly down today to an emergency meeting in Dallas, Texas regarding your partnership. We're at that meeting right now. I stand before you as the only remaining and surviving general partner of your partnership. It's unfortunate, but the unfortunate news is that the other general partner that was effectively managing your partnership, Robert Hill, has either died, gone insane, or retired right in the middle of this partnership. Are you with me so far?
Yes.
The remaining and surviving general partner asks the limited partners for 2/3 majority vote for you to allow the remaining and surviving general partner to continue to manage your partnership upon the death, retirement, and sanity of another GP. Are you with me so far?
Yes.
You will deny me Series 7 2/3 majority vote, Series 7, because upon the death, retirement, and sanity of another general partner, or a general partner, if there was only singular general partner managing this partnership, those provisions, look at me now, are the occurrences that if they did occur, will automatically terminate the partnership's life. Built into Series 7 Bullet 2, the Certificate of Limited Partnership, they want to know where that provision is located in the certificate, that would automatically terminate the partnership life so that the partnership, listen carefully, does not possess continuous life, which is a corporate characteristic, or so far.
Yes.
So the partnership now contains no more than two of those four corporate characteristics, so that we can be structured and designed according to the tax code of the IRS as a partnership. We have maintained Series 7 limited liability. We have maintained centralized management, two of those four corporate characteristics. We have, in the partnership's infrastructure, eliminated continuous life. We have eliminated a limited partner's capacity to freely transfer by gift or sale part or all of your limited partnership interest to another limited partner, requiring it to be contingent upon the general partner approval. This partnership, this entity, possesses no more than two of those four corporate characteristics, which are the requirements in order to be structured as a partnership. Are you with me so far?
Yes.
Good. So we look at the basic certificate and we see its impact, and now we move to the second document that's also required in agreement in order to continue to move forward in this investment, and that second agreement and document is called the partnership agreement. This agreement is required to be filed when we want an agreement that talks about Series 7 Bullet 1, the rights of a limited partner and the liabilities of the general partner. When they ask you, and they will, for the document and or agreement that best defines the role and the relationship between investors, known as limited partners, and active managers, known as general partners, the answer to that question is the partnership agreement. And here's why. Because this agreement will itemize the investor's rights, which are limited partners' rights in any partnership, and the liabilities that the general partner has in a fiduciary role to the limited partners. And whenever you have a document that itemizes investors' rights and issuers' liabilities. Are you with me so far?
Yes.
It brings us much closer together and defines our role and relationship among one another. Unlike the basic agreement, which is the basic certificate, which has a completely different purpose. Are you with me so far?
Yes.
As the basic program outline. And so, in the body of your work at the top, we talk about some of your basic rights. I do not want you to isolate and identify every right, only the selective rights that I give you for NASDAQ. Are you with me so far?
Yes.
Let's just talk a little bit for a moment about some of your basic rights as a limited partner in any partnership. You have the right to inspect the books and records of the partnership, am I right?
Yes.
To demand all true and full information set forth by this partnership. To require that the general partner act in a fiduciary capacity and distribute out to you all passive income and all passive losses, am I right?
Yes.
And the right to receive that passive income and the right to receive that passive loss level. Are you with me so far? From a profitable or a non-profitable program. You have the right, look at me, to sue me if you believe that I, your general partner, has violated the fiduciary role in the management of your program and your assets. Am I right?
Yes.
You can invest 7-1 in a competing oil and gas program or real estate program that's competing with this program. The general partner may have absolutely nothing to do, either as an investor or as a manager, with a competing limited partnership program that might be competing for the same natural resource. If we use oil as an example of Waco. Are you with me so far? Yeah. I have a conflict in that I may, as a general partner, have absolutely nothing to do with a competing program that competes for your resources. Are you with me so far?
Yes.
You can invest in a competing oil and gas program. Are you with me so far? You as investors do not have a conflict. The general partner does. Are you with me so far?
Yes. Yes.
You can also act as a general creditor to the partnership that you're a limited partner of. Look at me. I get down to Waco, Texas. Please look at me. And with your $25 million, I'm using your capital. And I see right away within the first 6 months that we really needed $30 million. We're $5 million shy down here. You with me so far?
Yes.
I contacted one of our existing limited partners in Waco, Texas, Jose Rosa, who has $1 million in Waco. And I said, Jose, you have a $1 million investment in Waco, Texas that you have limited liability for. You with me so far?
Yes.
But we're really $5 million shy down here. Will you consider, limited partner, to Waco, Texas, making a $5 million loan to this partnership? We're in need of $5 million in additional capital. If Jose Rosa makes a $5 million loan to this partnership, how much money does he now have invested in Waco, Texas? $6 million. If 16 months later or 2 years later, just to use a holding period for an example, this partnership experiences termination only because of the death, insanity, or retirement of a GP. Are you with me so far?
Yes.
How much money has that limited partner lost in this partnership? He can't lose $6 million. The maximum he can lose is $1 million because that's what the concept of limited liability is talking about. Well, what about the $5 million loan? For the $5 million loan, are you with me so far? The limited partner Series 7 is a general creditor. Are you with me so far? Now, here are the two fine points that you need to be aware of when we talk about some of your basic rights. We're still in this document called the Partnership Agreement, and I am finalizing now one of your final rights, that you have the right to invest money in the partnership in the form of a loan. Are you with me so far?
Yes.
What has the loan done to the limited partner's basis? Please listen to my language. Your basis now has been adjusted upward. Clearly, the word basis means the capital amount of money you have invested in the partnership. Clearly, Rosa has $6 million invested in this partnership. Am I right?
Yes.
So the loan, point 1.7, has adjusted your basis upward. Correct? Your basis is the amount of money you have invested in the partnership. You've invested $1 million in the form of your original cost basis. That's the original capital investment that was required for you to invest in the program. Am I right?
Yes.
That original dollar amount of money is known as Series 7 Bullet 1, your original cost basis. Watch my language. Then a limited partner made a loan to the partnership of $5 million. The loan adjusted the basis upward to $6 million. $6 million is known as, in my example, the adjusted basis. There's a significant difference between the original basis and the adjusted basis. The original basis, I'll say it again, is the original capital invested in the partnership. The adjusted basis is whether it's gone up or down for a financial transaction that have occurred. The financial transaction that has occurred here is a limited partner invested capital, made a loan to the partnership. Are you with me so far? That's over and above the cost basis. Clearly, he has $6 million invested in this partnership. His adjusted basis went up by the amount lent. Agreed.
Agreed.
But 7, you only have limited liability for the original basis. For the amount lent, you are a general creditor. Are you with me so far?
Yes.
So we're going to see today many financial transactions that may occur over the life of the partnership, over the year, that could affect your value, how much you're worth. Are you with me so far?
Yes.
The effect on your value or how much you're worth is known as your adjusted cost basis. You could be worth more or less than $1 million throughout the entire year, so that by the end of the tax year, it is the responsibility of the general partner to find out your adjusted cost basis, whether you're worth more or less than $1 million for many financial transactions that have occurred throughout the program life. The first of many transactions that I'm qualifying for you right now is a limited partner made a loan to the partnership. That loan adjusted the basis upward. Clearly, you have $6 million invested as an example in Waco, but you only have limited liability for the original basis for the amount lent. You are a general creditor. Are you with me so far?
Yes.
Well, these are some of your basic rights in any partnership. It was clear that we wanted to isolate and identify two specific rights for NASDAQ. One was that a limited partner has the capacity to transfer by gift or sale part or all of his limited partnership interest to a non-limited partner. With GP approval, you have the right to transfer by gift or sale part or all of your limited partnership interest in Waco, but it's not free for you to do so. We said so earlier. It is contingent upon GP approval. We also said that you can invest in a competing program. GP has a conflict. You do not as investors. And now we're saying that a limited partner can lend money to the partnership, and for the amount lent, he's a general creditor for. The limited liability portion is only for your original basis. Are you with me so far? These are some of your basic rights in any partnership. And wrapping up the partnership agreement, are you with me so far? We talk about the general partner's liabilities to the limited partner. I have the liability in a fiduciary role to represent you, are you with me so far, as your fiduciary, to distribute out to you any and all passive income and any and all passive losses, are you with me so far? Yes. To actively manage this partnership and maintain its books and records, are you with me so far? Yes. And work for an active managerial fee. Now, I may not admit another GP or another LP without 2/3 of your majority vote, and more importantly, we said, and we need to say it again, I may not continue as the GP of this partnership, management of this partnership, without 2/3 of your majority vote upon the death, retirement, insanity of another GP, which of course you will deny me. Are you with me so far? Yes. Should a GP die, go insane, or retire, because those were the occurrences that, if they did occur, would automatically terminate the partnership life, so that the partnership doesn't have continuous life, so that we can continue to be structured as a partnership and avoid corporate structure. Are you with me so far? Yes. I'm telling you right now, this partnership is out of business. GP dies. Are you with me?
Yes.
Now people have to get paid. Are you with me?
Yes.
Claims are going to be filed against the partnership. The specific question on NASDAQ is, the following is the order of priority of satisfaction of claims against the partnership upon its dissolvement as a result of the death, retirement, insanity of a GP. There is an order of priority of whom has to get paid first, second, third, and fourth. Are you with me so far? The order of priority that you see in the body of your work right there is inaccurate for NASDAQ. First party that gets paid, Series 7 Bullet 1, is the IRS. Write it in. Second, unpaid workers. All of those unpaid workers that work for Waco, Texas, right on that drill site, get paid second order of priority. Third, secured creditors. Secured creditors are institutions or individuals who have lent money to the partnership in the form of a loan, and that loan was secured with assets that will be sold out there in the secondary market to repay those lenders. Are you with me so far?
Yes.
Fourth, general creditors, like the Jose Roses of the world or any qualified financial institution who's made a loan to the partnership that is unsecured, where there is no collateral tied to the repayment of that loan. Are you with me so far?
Yes.
Fifth, limited partners. Sixth, and finally, if there's any money left over, after all categories and claims have been filed and satisfied, the general partner. I'll say this one more time. The question is placed, look at me on NASDAQ, in a Roman numeral sequence, distorting the order of priority under the assumption you don't know its sequence. Are you with me so far?
Yes.
The following is the order of priority of satisfaction of claims filed against the dissolved limited partnership upon the death, retirement, insanity of a GP. IRS, unpaid workers, secured creditors, general creditors, LPGP. 7. You got it, yes or no?
Yes.
This is NASDAQ. No question. And so now, yes, sir.
Say the general partner notices that the partnership needs a loan. Is he allowed to lend money?
He can lend money to the partnership as well. But he would be a general creditor for the amount lent. Absolutely. He's not in violation of a fiduciary role simply because he's a general partner if he makes a loan to the partnership. Any amount of money that's lent to the partnership in the form of a loan would be treated as a general creditor, and that's fine. That's not a conflict. It's not NASDAQ, but I'm going to answer your question anyway because I don't want you to think about it anymore. Are you with me so far? Good question. I'm sorry? The interest rates on the loans are also not on the Series 7 examination, part of real life, and so now I'm cutting you off at your knees. Are you with me so far?
Yes.
Good. I'm going for NASDAQ's jugular. We can have a wonderful discussion at the break about the interest rates and about fiduciary roles that are over and above the top of the 7 later on today. Are you with me so far?
Yes.
Thank you very much. You know, we talk about these two documents. I want you to look at them more acutely. Basic program agreement and the certificate. The rights of the investors and limited partners and the liabilities of general partners. Nowhere here in the certificate or the partnership agreement has the limited partner signed any documentation that binds him into the investment. Are you with me so far?
Yes.
You haven't signed anything here. Nowhere here in these two documents do I see a limited partner being qualified for suitability. And you're not investing in anything in the market as an investor unless you're qualified from a suitability point of view. Are you with me so far?
Yes.
And so now I give you, before this break today, the third and most powerful document that binds your investment. And that document is called the subscription agreement. Look at me carefully. When you, as the limited partner, watch me now today, sign the subscription agreement, you are subscribing into this investment. Only then will you formally be accepted as a limited partner in this investment. Are you with me so far?
Yes.
And that document has to be Series 7, co-signed by the general partner. Point 1 of 4 on the NASDAQ concerning the subscription agreement is, it is only when the subscription is signed by the limited partner, co-signed by the general partner, is the limited partner formally accepted as a valid investor in the partnership. Which would then mean, point 2, that the subscription agreement, ladies and gentlemen, is serving as your confirmation to your investment. There's your confirmed document. And that's got to mean, point 3, that the subscription agreement must qualify the limited partner for suitability. And the suitability standards on point 3 are dual in nature. Bullet 1, NASDAQ on suitability, that the limited partner is accredited. And qualification of either $1 million in net worth and or $200,000 in annual income for the last 2 years with anticipation that that income level be maintained. We know the definition of accreditation financial. So the first qualification of suitability with respect to risk is financial. Are you with me so far?
Yes.
The second criteria associated with suitability is psychological suitability, Series 7. In that, psychologically and mentally, the limited partner agrees to the long-term illiquid nature of the investment. Are you with me so far? You mentally agree, psychologically, that you're prepared to lock your investment up associated with a long-term illiquid investment. Psychological and financial are the two requirements for suitability. Are you with me so far?
Yes.
If you are financially accredited but psychologically not agreeing to the long-term illiquid nature of the investment, you are ultimately non-suitable. Even so far,
Yes.
you must meet both definitions of suitability in order to qualify and to be accepted as a limited partner in the partnership. Are you with me so far?
Yes.
Suitability is dual in standard, and of course, the fourth area of regulation is that in the subscription agreement, we should qualify where you sign on the dotted line the amount of money to invest in the $1 million in my example, which is the cost basis. Are you with me so far?
Yes.
So the document known as the subscription agreement contains the cost basis. In summation, again, of these fine points associated with the subscription agreement, it is bullet 1, signed by the LP, co-signed by the GP in order for the limited partner to be accepted as a limited partner in the partnership. It is serving as the confirmation documentation to the investment for the limited partner. It qualifies the limited partner for suitability, dual and standard, and it contains the cost basis. 7, 3 documents, 2 classes of partners, and when you come back in 10 minutes, we're really going to light it up. Because when you come back in 10 minutes, I'm going to tell you exactly what we're going to do right now. We're going to take the $1 million and invest it in massive numbers of programs. Are you with me so far?
Yes.
We're going to go into the program investments, and after we go into the program investments, we're going to go into the tax ramifications of this tax shelter, which is really where the regulations start to build. So, when you come back in 10 minutes, the programs, their financing, and the tax ramifications of this tax shelter. I'll see you in 10 minutes as we continue with the limited partnerships.